Hello and welcome. Today let's dive into the world of Joint Development Agreement, JDA in short, which is little confusing when it comes to taxation for landowners. Whether you're considering entering a JDA or already have one in place or simply curious, understanding the income tax implications is crucial. So in today's video, let's break it down. As usual, let's start from the basics and understand what's JDA. JDA is an agreement between the landowner and the real estate developer or builder. Here, the landowner contributes land and the developer handles construction in exchange for a share in the final developed property. It is a win-win for both because the landowner is not required to spend for construction. Similarly, the builder is not required to spend for buying the land. To have a better understanding of this, let's consider a scenario. Let's say you're the landowner and you give your land to the developer. Remember, at this point of time, you are still the owner of the land. In other words, ownership is not yet transferred. Now, this land is given to the developer to construct, say, 10 apartments. Necessary approval, registration, marketing, etc. in connection with construction of 10 apartments would be developer's responsibility. Once the construction is completed, let's say you get 60% share, that is 6 apartments. So the developer gets the remaining share, 40% or 4 apartments. Plus, let's say the developer also pays you some money. The developer may or may not pay this money, but in this scenario, let's say the developer pays you money. And this money can include consideration in cash, check, draft or any other electronic mode. And the 60% share that you get, that is 6 apartments, you are free to sell these apartments to other buyers. If you observe the chronology of events for landowners, being a landowner, 1. You give land to the developer, 2. Developer constructs 10 apartments, 3. You get 6 apartments, 4. You get money from the developer, 5. You sell these 6 apartments to other buyers. In income tax law, these events for landowners trigger 2 transactions. 1. Being a landowner, 40% of the land is given to the developer against which you receive 60% share of developed property plus money. 2. Selling of these 60% share of apartments to other buyers. The tax treatment is different for both these transactions. We'll shortly discuss about this. But before that, let's understand how a typical sale of immovable property like land or building is taxed in income tax law. If we keep aside commission agents, there are 2 parties involved, the buyer and the seller. If you are a seller, then difference between the sale value, that is sale consideration, and purchase cost, that is cost of acquisition, would be your capital gain on which you are required to pay tax at applicable rates. And this income tax is levied in the year in which you sell this immovable property. Another important thing to remember is the holding period. If you sell this property after 24 months from the date of purchase, then you can adjust the cost of acquisition for inflation. That is indexed cost of acquisition. To have a better understanding of this, let's consider a scenario. Let's say here is your land which you have sold it to some person for say rupees 50 lakh, that is your sale consideration. Let's say you had purchased this land from some other person for 30 lakh, that is your cost of acquisition. So the difference between these two, that is rupees 20 lakh, would be your capital gain. Now let me give a twist. Let's say you have sold this land in the year 2024, but you had purchased this in the year 2020. That means you have sold it after 4 years. So the holding period here is more than 24 months, because of which you can adjust the cost of acquisition for inflation. Now the indexed cost of acquisition here would be rupees 36.12 lakh. So the difference between sale consideration and cost of acquisition would now be rupees 13.87 lakh, which would be your capital gain. In this video, we are not going to talk about computation of indexed cost of acquisition because I already have a separate video on this topic. If you would like to know more about it, you may consider watching it. The link is in the top right corner. Now coming back to the scenario, the crux here is if you sell this land within 2 years, then the capital gain would be rupees 20 lakh. But if you sell it after 2 years, and in this scenario, the capital gain can reduce to rupees 13.87 lakh. This is how sale of immovable properties is taxed in income tax law. If we compare this with JDA, in case of JDA, landowner is not selling the land. Instead, the land is given to the developer for construction. And once the construction is completed, the landowner gets her or his share of developed property back. This is the first difference. So, when you enter into a JDA, being a landowner, 1. You are essentially disposing of the land and acquiring a share in the developed property and usually some money from the developer. 2. You would be selling your share of developed property to other potential buyers. And both these transactions trigger capital gains tax, but the method of computation is different. Why is it so? Unlike the sale of immovable property where there are two parties, the buyer and the seller, in case of JDA, there are three parties involved: the landowner, the developer and the buyer. This is the second difference. Because of these differences, taxation for JDA is not same as that for sale of immovable property. So, in such a situation, being a landowner, it is obvious for you to have questions like how is capital gain computed? I mean, what is the sale consideration? How is the cost of acquisition computed? What's the holding period of asset? As a landowner, when do you have to pay tax? Is JDA beneficial to you? And so on. So, in today's video, let's try and answer all these questions and more. In JDA, to compute capital gain, three terms are relevant. 1. Full value of consideration. 2. Cost of acquisition. 3. Year of taxability. We'll understand each of these terms starting with the first one, full value of consideration. As usual, for easier understanding, let's consider a scenario. Let's say you are the landowner and you enter into a JDA with a developer on 1st April 2021. As part of this JDA, let's say you give your land of say 4,000 square feet which you had purchased on say 10th May 2010 for rupees 20 lakh. Now this land is given to the developer to construct 10 flats, out of which you get 6 flats and the remaining 4 flats would be developer's share. On 1st April 2021 itself, let's say the developer pays you an advance of rupees 10 lakh which is directly credited to your bank account. After some time, the developer completes construction of these 10 flats. Let's say the date of completion is 1st June 2023. Now what do I mean by completed here? Date of completion here is the date on which certificate of completion is issued by the competent authority like development authority, municipal corporation, etc. So as a landowner, your share out of 10 flats would be 60% and developer's share would be 40%. So you get 6 flats and developer gets 4 flats. Let's say on the date of completion, the stamp duty value of this apartment is rupees 25 lakh. Now considering stamp duty value of 25 lakh for 6 flats, the value would be rupees 1.5 crore plus the developer has paid you 10 lakh as advance. So the total here is rupees 1.6 crore. The essence of this transaction is, as a landowner, you have given 40% land to the developer and the developer has given you rupees 1.6 crore worth of property and money. Now this 1.6 crore here is the full value of consideration. Now let's straight away jump into the computation of capital gain. In this process, we'll understand the other two terms, cost of acquisition and year of taxability. So, you are the landowner and you have entered into a JDA on 1st April 2021. Now, we already know that JDA would trigger two different transactions. 1. 40% land that you have given to the developer. 2. 60% share that you have got out of the developed property. Let's first talk about 40% land. Now, the date of completion is 1st June 2023. So, this is part of the financial year 2023-24. So, year of taxability would be FY 2023-24. So, we have understood the second term, year of taxability. Full value of consideration we have just computed, it is rupees 1.6 crore. From this, we have to reduce cost of acquisition. If you remember, you have purchased this land in 2010. So, the holding period here is more than 24 months. So, the indexed cost of acquisition for 40% of the land would be rupees 16.67 lakh and the difference between these two would be your capital gain, that is rupees 1.43 crore. And if you satisfy certain conditions, then you can avail exemption under section 54F and on the balance you have to pay tax at rates as applicable to you. Now let's talk about the second transaction, 60% share, that is 6 apartments that you have got out of this JDA. For ease of understanding, let's say you have sold all these 6 apartments on 1st Jan 2024 at 50 lakh per flat. Now, since this is part of the financial year 2023-24, the transaction is taxable in FY 2023-24. And the sale consideration here is 3 crore, that is 50 lakh multiplied by 6 flats. And when it comes to cost of acquisition, whatever is the full value of consideration for the first transaction would become your cost of acquisition here. And the difference, that is rupees 1.4 crore, would be your capital gain, on which you have to pay income tax at rates as applicable to you. Now the crucial question, is JDA beneficial to you? Of course it is beneficial, because here capital gains tax is triggered only in the year when the construction is completed. In other words, you don't have to pay tax when you sign the JDA. This is crucial because real estate projects usually take several years for completion. So this delayed taxation can help you pay tax when you actually get the benefit, that is developed property. In order to reap this benefit, you have to satisfy 2 conditions. 1, you have to be an individual or HOF. In other words, this benefit is not available for firms, companies, etc. 2, you have to register JDA. Just like you register sale or purchase of immovable property or gift deed with the sub-registrar office, you have to register your JDA by paying stamp duty at rates as applicable in your state. The next question that would come to your mind would be, what if you don't satisfy one or both these conditions? Or let me put it differently, what if you sell your share before construction is completed? In such a situation, this concept of delayed taxation is not applicable, and tax treatment is similar to sale of immovable property, which we had discussed initially, and capital gains tax is triggered in the year of sale itself, and date of completion would be irrelevant. Another important thing that you need to remember is TDS provisions under section 194 IC. In JDA, you get share of developed property, plus developer sometimes pays you some money, and on these payments the developer is required to deduct TDS at 10%. If you don't have PAN, then it would be 20%. And there is no threshold limit here. So even if the developer pays you small amount, the developer is required to deduct TDS at 10%. And this rate is applicable only for resident landowners. So for non-residents, rate of TDS would be much higher. Considering our earlier scenario, here instead of 10 lakh, the developer would deduct 10% of this, that is 1 lakh as TDS, and pay directly to the government, which in turn is credited to your account, and the balance 9 lakh would be credited to your bank account. If we have to quickly understand the taxation of transactions for developer, because developer also has a share in this JDA, sale considerations received from buyers for sale of developer's share would be business income for the developer, which is taxed under the head profits and gains of business or profession. The developer can avail deduction of expenses incurred, and if there is a profit, which certainly would be there, the developer is required to pay tax at applicable rates. With this, it is a wrap on this episode. Hope it was informative. Thank you for watching.